Hey guys, Sierra Bailey here with Accel Commercial Real Estate. The video you're watching ties into our event in June, Accelerate. If you want to learn more about what you see today, scan the QR code on your screen or click the link in the description to get your tickets now before early bird pricing runs out. Enjoy the video.
Go ahead, Mickey.
At what point in your career did you realize that you needed someone else to help you run the business?
So that's a good question. I was lucky that I was working for a big company, and I was a project manager for them for a big capacity of time. So I knew how to run like mega projects. Schneider was I don't know if you heard of Schneider, but their customer base is like, we sold electrical equipment to to Saudi Arabia, to Google, Amazon, things like that. So you're managing $50-60 million projects to execute on. So I kind of knew that as we grew the company, I need more back office. And the tricky part is the back office, because that back office keeps your engine running. And when I say back office, I mean your accountants, your bookkeepers, your ability to get pay your employees and pay your subs, right? We pay all of our subs and all of our employees weekly. We structure it in a form where it's extremely difficult for us to get it done every single week. We do it because we want to provide good customer service to our sub base, but then we also have to get our money back from our investors every single week too, which everybody's right now, like the company's set up where from the sub base all the way to the investor, everyone's on the same page. We know that we got to pay people weekly, we got to get funded weekly, and we got to we got to make sure that that we have positive cash flow, right, on a weekly basis. And it's a lot. So it's a lot, and again, it's another separate topic, but we want to make sure those, because what happens if the funding doesn't come in, then check starts bouncing, right? So nobody's going to be happy if that's the case. But so to answer your question, you're gonna have to, as you grow your business, you're gonna have to figure out where to plug your holes. So if you're like, I realized from the very beginning that as I grew to like 2, 3, 5, 4, 5 more houses, I banged my head against my dining room table Thursdays and Fridays trying to do paperwork, because I had to I had to log in all the expenses. I had to send out funding requests. It was a 2-day request, and and then on Fridays I was, handwriting checks and giving to everybody, right? That had to all stop for me to even scale. So how do I get rid of that, but do it effectively to be able to have, to be able to issue checks and to be able to cross-check and be able to get the investors comfortable with what we're trying to do on a scalable level. I'll say that the accounting, the bookkeeping piece is probably the most important part. I can always hire more project managers to hire builders to build houses, because there's most of this business that I've realized is that there's tons of builders out there building houses with a truck and a guy and a cell phone. But how do you scale it to where you can actually do 50 houses a year? That's not a truck, a cell phone, and a guy. I promise you that. It's a process, So that's a part that I think, as you grow your business, you got to understand how to make your back office to be the engine of the front office.
Well, I think there's a couple of things. Just I know we're going to be running out of time here, but I think for me anyway, listening to Ben earlier, and he was talking, and I think maybe he was answering one of Allison's questions about kind of the payout on the LPs, right? And how even the payout, he's, kind of keeping them still in a deal, right? And from the fact that he's doing that because he knows that, they're gonna fight for him, right? They're gonna go to battle for him. He needs to go back and get more, it's how he treats them, right? And I think the same thing that Key's talking about is the same kind of way when you were talking about even with some of your investors, or that you pay your subs weekly, because right now I'm sure it's not the easiest thing to do to find a lot of real good subs, right?
Mm.
And I'm sure if you're paying them on a weekly basis, they're like, absolutely, Key, what's the next project?
Yeah,
can
we
go to,
maintain-
right?
We
So,
maintain loyalty that way.
yeah, so it's that loyalty, and I think that's
Mhm.
what Ben was saying, about him with his LPs and his investors, and what you're talking about, not only with your investors, but your subs. I think it's the same thing. I mean, that's one of the huge points, I think, out of tonight of, listening to both, speakers is building that loyalty, and that loyalty matters, right? So.
Yeah, we try to treat our subs as a partner. We don't, I mean, we treat them the same way we treat our investors too. I mean, they are, they come to our functions. They call me brother, we don't look alike, but
That's all right.
yeah, but we
He's
try to
our
treat,
adopted
I mean, if you treat people with respect for a couple of things, one, respect us in the field, and secondly, you pay them quickly, because that's a huge way to be a differentiator from your. Now, if I was net 30 with all of my subs, I would not be able to run this company as effectively as I can right now, because these guys pay their guys on a weekly basis. I can guarantee you that a lot of them are not financially savvy. So if the dollar comes in, if it's not getting paid out to their subs, then, or if they're having to float money for 25 to 30 days, they're hurting, and chances are they ain't gonna be working for you anymore, because they're gonna go find someone else that can better manage their cash flow, right? So, and when I was with Schneider, I was like, why can you just not wait a month? Like I can live 6 months or a year without any income. It doesn't work like that, especially if you want the good subs. The good subs that are great in skill set in their trade, may not necessarily be the people that are financially savvy, so that their cash flow needs to be extremely quick so that they can keep their guys all paid up. And if I can provide that service for them, yeah, I'm gonna get the better service I'm gonna be the competitive advantage over other people, because I pay you every Wednesday,
So are there, switching back kind of to the due diligence and what you're doing, is there a lot that's too small, and what is that number for you? And then are there zonings that you will just not work with or touch?
So there's a couple things. Your first question is when she says, when there's a duplex lot that doesn't meet the minimum square footage requirements. So if you had like an R10, which means residential, you can put 1 or 2 houses on it. It's got to be 10,000 square feet. And if you're short, the question is, what is the right number for you to actually go through variance? And there's not really an exact science, but from my experience, it's 5%. So if you're more than 5%, chances are lower. If you're less than 5%, chances are higher. Now, obviously, you got to be in a neighborhood, and we can get into more like whether it's a maintenance or evolving neighborhood or things like that. But 5% is basically the rule of thumb for a lot of people. If you're 10% low on your square footage, you don't have a very good shot. I feel like, but you can try it, I mean, you may have, and also went during that day of the variance, it matters whether or not your neighbors come and complain or support you. So that's also extremely part. I've had one in Green Hills where we're short 5%. But you know what, this very nice lady says that she does not like these density, and she wants have bigger homes in the neighborhood. Guess what? I did not get granted my variance, because because the constituents in that neighborhood really matters in the voice and the opinions of what you're trying to do. So
especially in those kind of areas.
Well, yeah, in a very mature neighborhood, right? It's more so than others. But I still think it's probably worthwhile to go through it if it means so much more to be able to do 2 homes on that specific lot versus 1 home.
Now, are you doing that during your contract period due diligence, or after you closed and you're trying to figure out?
So I always I always try to be very clear with the seller to say, hey, if I can get the grant, if I could be granted 2 units, this is the value. If I don't get granted the two homes, here's the value. It's not half, because you get more value from a nice wide house than a two tall skinny houses, but you do have to discount it a little bit. And we just have, and sometimes most of the time I think everyone understands, and we can come to an agreement, but sometimes it doesn't. So it just depends on the person and the deal.
Frankie, so go ahead.
Couple things to touch on with my competitive edge that you were talking about. So that last question kind of added a little bit to what I was going to ask, but so this may have 2 points to it. Are you making a lot of stuff contingent, what you were just talking about? And can you were talking about moving kind of fast and whatnot, but a lot of those contingencies kind of, aren't, when you have contingencies, that makes your offer look a little less attractive.
Right.
So just kind of maybe touch on that. And then the other thing would be where you are with land cost percentage, like you work on the percentage of your exit price, and then obviously being competitive. We know, I mean, you and I have talked a number of times, like, hey, so-and-so wants X for this, and that's not where I want to be, but we see so much of that they're higher than maybe where you want to be. What do you, like, do you think maybe, as we've seen in the last few years, well, 8 months from now, I can maybe make up that 20 grand that most people aren't paying for a lot? Or do you have a different way of looking at that?
Sure. So I guess his two questions are, number one is.
Sorry.
Can't do that. We can't repeat all of that.
I'm not gonna repeat everything you said. I'm gonna have to come here and repeat everything you said here.
It's more about competitive edge and, with contingencies and with percentage of land cost.
Right.
Exit price.
Yeah, so his number one question was, is that when we go and try to lock in a property, what do we, and if it has some due diligence issues, what do we do in terms of due diligence, and whether if we accept those risks contractually, or whether if we just whether if we actually are contingent on all those abilities to do two homes or things like that. And then his second question was, I forgot now.
Price of land.
Price of land, right? In
Yeah,
general,
percentage.
in general.
Percentage of the
of the deal when you exit the property.
So the number one thing is, I don't ever, and I'm very clear and honest, it's like, we don't ever take on a project hoping that it's going to do two houses on the lot. I mean, that's just, you're really kind of, to me, you're really playing with fire. Like, I can't be like, no due diligence, earn us money hard. It's short, but I'm going to pray that it's going to be granted, from the Board of Variance 3 months from today, that it's going to be two homes. So, I mean, that's not a prudent way to do business in my perspective, but some people may, and the only way that you can actually probably do those homes that are that way is if it's in an involving policy. And you need to, and if you don't know what that is, then you need to do some research on the involving policy in Davidson County. So we always say, if it's a build two, this is the price. And if it's not, then we'd have to renegotiate the price. It's not half, but again, it's something where the numbers got to work. And then it follows up into your second question, which is, what do we pay for land, right? In general, for a build two, we typically are still at 25% of land cost versus sales price. So what that means is, if I buy a lot and it's $400,000, I can build two houses on it. It's $200,000 per pad for the lot. It's $400,000 for the bill, and it's $200,000 gross income. So, and that the gross income can be, you can take out several different things in it, but that's generally the rule. Is if someone's gonna offer me this lot and I'm looking at comps, I'm like, if this is $400,000, can I do two $800,000 houses on it? That's basically the general rule for most developers, I would say. And sometimes, and I would say, like in East Nashville, it's very much like on the like right there on the border, right? Because there's like 1,000 people in East Nashville fighting for that same 350 land that's out there, because everyone's chasing those per pad prices, right? And so your numbers there is probably going to be right at 25, 50, and 25 margin, and that's kind of how people are playing that specific game, because there's so many people that are focused on price points. But I would say it's not the same in Green Hills. Green Hills, you can go and we go buy $1 million lot with build 2 houses on it, and we can sell each one of them for $3 million. That's definitely not a 25% rule, right? So I mean, that's because there's because you have to execute on you're executing and investing in such a larger risk that you should be able to get more than 25% return on that investment. So it's not the same, but the general rule is 25%. I think you'll do better in some of the more prime areas where you can do $2-3 million homes. And also, I would say the 25% rule doesn't work on a single build either, because we buy single build lots, we tear it down, we build. And the reason because is your build cost for 2 homes is way more than your build cost for just 1 home. Means most of your money that you're building is in your master and your kitchen, right? And when I build 2 homes, I have to build 2 masters, 2 kitchens, which is way more money than what I have to invest into just a single build home. So that number, I would say maybe like a third, but it's not that's not the. But we have to look at those case by cases. But we don't. But to answer your question, our 2 builds are 25, 50, 25. Our single builds, we look at it definitely not at 25, 50, 25, because those numbers will never work. I think in many cases don't work, but we still look at those and see what the returns are for those projects.
All right, well, that was an hour, T. That went fast, didn't it?
Yeah.
Thanks for watching this video. If you like what you see, be sure to follow our Generational Wealth Learning series. On select Thursdays, we offer cutting-edge industry information that would normally cost thousands of dollars. And the best part, our education is absolutely free. If you register through our events page, you can join us live, either in person or over Zoom. In the meantime, like this video, comment down below, and subscribe to our channel so you never miss a beat.